My next guest says the odds of a Fed rate hike are substantially higher than markets are pricing. Joining me now is Ben Emons, founder and CIO of FedWatch Advisors. Ben, great to have you here.
Good to be here, Caroline.
Especially big day with Kevin Warsh just finishing up his speech at Jackson Hole. We'll get to the market implications, but first, market's pricing in roughly a 45% chance of another hike come September. Your models are pointing to a more than 70% chance. So tell us, what is your model picking up that the market is missing?
So most of the Fed members currently are very about inflation, and they try to say we need to get inflation under control. Now the speech from Kevin Warsh focused on that as well. So before the speech, the probability was around 70%. It's likely after the speech even higher, which indicates that within the Fed, there's a clear consensus now that they need to take a step of action, which likely means they will raise rates. If it isn't in September, then it's in October. But in some near term, rates are going to likely go a bit higher to try to push down inflation because it's just not going in the right direction.
Well, we've actually seen the market reaction as kind of muted. First, we saw stocks a little bit lower. Now I'm actually looking at the S&P that's a little bit higher. Is a rate hike bad for stocks?
I'd say no, and here's why. In this environment where the economy is growing really well and has a lot of investment, if you put a rate hike in the system, it starts to slow down inflation. As that happens, the economy actually gets breathing room and can actually grow a little more because inflation is holding spending back, it's holding income to an extent back. So I think particularly consumers, retail, would benefit from a rate hike simply because a rate hike puts a bit more restriction, as they call it, into the financial system. And as that sort of filters through the economy, prices start to moderate a bit. And that's actually a bullish backdrop for stocks. Even though inflation is still there and they may have to hike again at some point, we don't know that, I think it's a bullish outcome.
So if your model is right and the Fed does hike in September, what's one area of the market you would want to own? And what's one area of the market for stock you'd avoid?
So I definitely want to own consumer discretionary because those are the sectors that should benefit. People's incomes are lower than normally is really because inflation is higher than normal. So they should benefit, I think. And then you will likely see more spending from consumers following. Maybe the areas where that is not so, let's say, advantageous would be, say, staples or materials, or some of the healthcare sectors. But other than that, it's actually a quite broad effect on the economy. Inflation moderates. So overall, it's actually a good opportunity to rotate, not stay only in tech, but look at other sectors like consumer discretionary and retail.
Would there be a delay, though? Because I would think that higher interest rates would mean the consumer would be facing even higher prices if they're looking for things like mortgages, say, that type of thing. But if the ultimate goal is to bring down inflation and then prices come down, eventually they'd pay lower prices. But wouldn't higher interest rates actually hurt the consumer unless we're talking about savings accounts?
It could be, but the way this mechanically works in the bond market is that if the Fed is very serious about bringing inflation down and by putting rate hikes in the system that are quite predictable, long-term interest rates actually decline. 30 years ago, 1996, that was the case too. The Jackson Hole speech from Greenspan focused on price stability. And he was really strong about it. And the 10-year yield was at 7% at that time and went down to 6%. So today we're at over 5% on the 30-year. It may start to decline now because Kevin Warsh today too had a sort of similar tone. We cannot let inflation continue this way. Got to focus on bringing it down. If you're doing it in a predictable, moderate way, instead of slamming the brakes with raising interest rates really quickly, then yields are likely to decline. And that itself will be good for housing too. So eventually the housing sector, I think, will be another play to think of. But consumers are probably going to benefit because consumer prices may start to moderate from here.
If investors or the market if they're not adequately pricing in this rate hike yet, though, what happens when they do? Does that mean we'll see the market dip to price it in beforehand?
It's mechanically maybe a little bit possible, but technically what happens is that these odds are very fluctuating, They change day to day, including in my model. So it's a bit more like a projection, like a model idea. People looking at it saying, okay, there's a decent chance, because if it's more than 50%, that's a decent chance that the Fed will move. If there's no surprise in their language ahead of the meeting or at the meeting, then the market will not react negatively. It will actually be digested easily, so to speak, and likely we'll see the market getting a relief rally. This would happen in 1996 actually, and it's I think this time the same case.
A relief rally, but the S&P 500 is already only 1% away from all-time highs. So as you think about where the market goes from here, are you bullish, and how much higher can it go?
I'm definitely bullish. Just take the earnings and investment in the economy for the fundamental reasons. There's nothing to be really negative about. If we also deal with a Federal Reserve that's not going to derail that fundamental backdrop by just aggressively raising rates, but they're doing it moderately, then it only becomes a more bullish outcome because you're getting growth, investment, good earnings, with inflation moderating. And that I think that's the bull case overall. So the S&P could easily then reach 8,000 or more, and I'll be in the camp of others who have called for this, really because you project out how the economy can behave under a better, more moderate inflation. That's a pretty good outcome.
So if I have cash on the sidelines, am I putting it to work right now, or am I waiting?
I would already put investment in the market currently. I would not sit on the sidelines with so much cash. There's not any type of like major calamity happening currently. The conflict with Iran is really moderated. And although they have to figure out the Strait of Hormuz and that sort of thing, it's not really going to deter the market any longer. The only thing that I could think of as an uncertainty ahead of us are the midterm elections. But that's still about 9 weeks away. We got the Fed meeting in between. So I would be more focused on that and thinking if what I described is the scenario, and a Fed that's going to moderately maybe raise interest rates once or twice in the future, it's all very predictable. You want to put money to work today.
And let's talk about the areas that you're most bullish on. Obviously, you said consumer discretionary would benefit from a Fed rate hike as long as they're moderate rates and not anything really aggressive. What other areas of the market do you like here?
Well, I still like much the semis and technology. I think that the software sector now making a recovery, it makes a lot of sense because that was somewhat misplaced. AI is actually enhancing software. So I think that's an opportunity still there. There's a lot of stocks that are much more lower valued, particularly in price than those in say, the parabolic 7 that I dubbed, that have really high stock prices. And those are particularly like semiconductor companies. And then I think the financials are in a really good place. They got adequate capital. There has continued to be regulatory relief. And if an economy picks up, it's more credit, there's more lending. So I think that's a good sector. Obviously, consumer discretionary. And I would play on energy. Energy is ultimately, that they have benefited a lot from the higher oil prices. These oil prices are not going to decline so easily. If anything, the economy grows better, there's oil demand, and demand for energy. But the conflict itself keeps oil prices elevated. It's given a lot of margin, profit margin to oil companies. So I'll be bullish there.
Can you give us any specific names that you would definitely have in your portfolio in a Fed hiking environment?
Well, my top three that I also work with clients on is I like Citigroup. That's a great bank. It's really made the recovery now finally. I like IBM because it's a very diversified play on AI and software.
Even after earnings?
Even after earnings,
okay.
Yeah. It's a really diversified play. And I like Micron as in it's taken a much more better lead and really captures now more and more market share in the semi space. As much as that stock has risen a lot, that's an attractive opportunity because it's a low multiple. It's like a low valuation stock. And I could think of Goldman Sachs as a final one, which I always like because it's capital markets, right? This is the environment capital markets are really thriving, especially I think even with a rate hike from the Fed. It's not going to derail that capital markets, optimism. So Goldman would be out of pick.
And you'd buy all four right now?
I have all four invested.
But if you didn't own them now, there's an attractive entry point here.
I think there's still an attractive entry point here in all of these stocks.
What happens if the Fed doesn't raise rates and inflation does tick higher or stay high?
Yeah, that would be a little different scenario because then you get the feelings in the bond market that the Fed isn't doing enough, that they feel that the traders, like what they call behind the curve, I guess that means that the Fed is just not enough ahead of this problem of what this inflation could become then. I don't believe that this will happen, but to your point, if the Fed gets too cautious, then I do think long-term interest rates will go back higher, and that would then put some dampening pressure on the overall market. That's likely the case.
And what's the takeaway for bond investors right now? Because we have a 10-year yield sitting right around 4.7%. The 2-year yield, as you said, is above 5%. I think it was at 5.2 last I checked. How should those retail investors who are sitting in fixed income or contemplating, adding some bond exposure, what should they be thinking about? And where are the opportunities, or what do they avoid?
So what's interesting from the bond market to the stock market, Caroline, is that the bond market is like a supermarket. There's a lot of different things you can buy there, very different stocks, right? So you can buy securities that are floating rates. You can buy securities that are issued by banks. You can buy securities at treasuries, emerging markets, international. There's all kinds of ideas. I run this fixed income strategy for my clients. I keep a very diversified strategy where I have these different types of securities in there. A floating rate security, preferred, which is like a bank issued security, some emerging markets and international for diversification, corporate bonds, the high quality corporate bonds, as well as some higher yielding bonds. So you take that sort of mix and you keep your interest rate sensitivity a bit lower than normal, you can outperform indices, you can have a decent yield. And I would add, and also municipal bonds are attractive because that's the tax exempt opportunity where the yields are something like around 4% tax exempt yields. That's to me attractive historically.
So for the everyday retail investor who still wants growth in their portfolio, but also wants diversified exposure, how much of this portfolio should be in stocks and how much should be in fixed income?
I think it's still sort of like, say, call it an 80% stocks, 20% bond environment. Why? Well, as you just asked me before, this uncertainty about interest rates is still higher than normal. So there's some volatility. And as we experienced over the last period, interest rates did go up again. We also have to keep in mind that although the Fed may be successful with future action to bring inflation down, until we actually see that, that's important for bond investors. Secondly, the economy continues to grow. One thing that people should know is that if GDP, gross domestic product, goes up, so do long-term interest rates. That's a close relationship, historically always been there. Conversely, if GDP declines, interest rates go down. So in a strong growth environment, so I have been advising my clients saying, like, you could do 80-20 on your allocation. If you like bonds, you should be more in shorter maturity bonds, anywhere between T-bills and say up to 5 years, and pick the ones I mentioned, so to diversify that exposure. Then I guess you could have maybe up to 40% in bonds and do the 60% in stocks.
I do know that 80-20 equals 100, 60-40 equals 100, but what about cash? Any cash in the portfolio? Because the one thing with an interest rate hike is I might actually get an email from my online savings account saying your rate has been increased versus the decreases that I've been getting.
Well, think of cash as an asset that brings the volatility of the portfolio really down. Because if you put things in cash, it doesn't move in any way, right? So that can at times be advantageous if you're in a uncertain period. But it's an opportunity cost. That means, if sitting in cash, you get some interest on it. But if you had invested that cash in stocks, you could have had significantly more return. So you have to make a bit trade-off there. Look at it more like tactical. You keep cash at times on the sidelines to wait out certain.
But now is not one of those times.
I don't think this is the time to be a high cash allocation. And I'm thinking there like 10-20% of your portfolio in cash. That would be high. Something always like 3 to 5% as sort of like a buffer for whatever you need it for, or to eventually put it to work in the market, but not 20%. Because this is not an environment that is so, let's say, uncertain and disastrous, if you will, to hold that much cash.
Okay, so just to wrap it up, what is the biggest risk to this market? What would need to happen for you to want to be in more cash? Because it doesn't sound like it's inflation or a Fed rate hike or Iran. So what's the biggest risk?
Well, there's one iceberg speed bump ahead of us, which is called the midterm elections. And if you follow the prediction markets, right, on calcio poly market, there's a decent chance that the Congress may go what they call blue, like as in Democrat. What does that mean? That means that potentially the data center growth that we've had that has been such a boost to our economy may slow down quite a bit because there's been such a political backlash building, around data centers. Secondly, it could change some of the, let's say, ideas that currently the administration has on any other taxes that they want to lower, investment, foreign investment they want to pull in. That could all change. So that would create some uncertainty. But historically, though, even though the Congress will become Democrat, you may get some pullback in markets, but then eventually it goes higher again because on a Democratic Congress, there continues to be robust government spending, which is really important to the economy. And that will eventually drive GDP again higher. So it's a speed bump, I think, ahead of us. We'll see how it plays out, right? I don't know that, but I think it's sort of like, it's a bit of the political environment. I mean, the only caveat that we could have a future debt ceiling as an issue, which somewhere in 2027. But we'll see how that plays out too. So
we'll have to get you back on as we get closer to that to see how the playbook changes, or maybe not. I think it's a great time to pivot to our rapid fire game of this or that. You know how to play. Quick questions, quick answers, no hedging. Are you ready, Ben?
Yeah, I'm ready.
All right, here we go. Stocks or 10-year treasuries?
I'm in stocks.
U.S. stocks or international?
U.S. stocks.
Large cap or small cap?
Both. Can I say both?
We'll give you one both, but if you could only choose one.
I would still go large caps, yeah.
High quality growth stocks or value stocks tied to the economy?
Value stocks tied to the economy.
Mega cap tech or financials?
I would take financials.
NVIDIA or an equal weight S&P 500 fund?
I would take NVIDIA, best growth company.
Short-term or long-term bonds?
Short-term bonds.
Cash or short-term bonds?
Short-term bonds.
Gold or Bitcoin?
I would pick gold.
Buy dips in stocks or take profits?
Buy the dip in stocks. Just do it. Don't get out of the market.
Bigger threat to stocks, a Fed rate hike or the 10-year treasury hitting 5%?
10-year treasury hitting 5%. That would derail the stock market.
September Fed decision, hike or hold?
Hike.
By year end, one rate hike or more than one?
One rate hike.
1 year from now, inflation closer to 2% or 4%?
Likely closer to 2%.
1 year from now, bull market or bear market?
Still bull market.
One word to describe how you're feeling about this market for the rest of this year.
Bullish.
Ben Emons, you played by the rules.
Thank
Our
you.
viewers are going to love that. Thank you so much. Really appreciate your insights, your picks, and everything else. That's Ben Emons, founder and CIO of FedWatch Advisors. If you enjoyed this Street Talk, check out our full interview with Andrew Graham. He reveals the stocks he thinks have the most upside from here and how to know when to buy them.